My name is Drew, and if we haven't met before, welcome to ReadyBudgetGo. If this isn't your first visit, welcome back. Either way, I'm glad you're here. This is My Money Relaunch, a series where I talk about things I've learned as I dug myself out of debt for the second time and started gaining control over my finances. Before we go into today's topic, there's a couple points I need to cover. First, I'm not a financial advisor. This series is for informational and entertainment purposes only. Before making any moves with your money, do your own research and seek your own counsel. Second, while I'm talking, I'll be putting down stickers in this paint by sticker book. For each sticker I place, I will save $5 toward one of my big goals. This week's target is 50 stickers for $250 in savings. Now that my emergency fund is fully funded, for this week and the next several weeks, I will continue stockpiling money toward the big move, which funds my relocation across the country this spring. This week, I want to talk about what corporate accounting can teach us and the concept of a fortress balance sheet. If you're already overwhelmed just by me saying those words, stick with me, because anything that you're unfamiliar with or that you might be unfamiliar with can seem daunting at first. But once you get used to it and once you have practiced it a few times, it just becomes second nature. And that's the same with me. I don't have an accounting background. I do work a 9 to 5 in a business, and I have been a product manager where I had to deal with some of these documents, but not to the level of detail that most accountants do. But still, I was able to adapt some of the concepts in corporate accounting toward my household budgeting, and it has really helped me to gain clarity and to plan for what I want out of the money that I earn. So let's first start talking about what some of these corporate accounting documents are. Most companies of any good size, or I should say probably most companies with employees is fair to say, prepare 3 statements each month. There's an income statement, there's a cash flow statement, and there's a balance sheet. And they're done in order for a specific reason. The income statement comes first, and you might hear that called a P&L or a profit and loss statement. It means pretty much the same thing. And that is all the money that you've earned and all the expenses you have incurred, whether you've paid them or not. It's just whatever came due in that month. A corporate accountant would separate taxes out from this, but for household budgeting, you can use net income and treat taxes separately. It's up to you. At the bottom of this document, it shows your net income for the month, whether it's positive or negative. If it's positive, you earned more than you spent. If it's negative, you spent more than you earned. And when I say spent, I'm using air quotes here again. Remember, it's not how much money left your account. It is, did you incur those expenses? So for example, you put something on a credit card on the 28th of the month. That bill isn't due until the middle of March. So you'll pay the bill in March, but you incurred the expense in February on the 28th. So you would write it down in the income statement as an expense in February, even though you're paying it in March. And that payment will show up elsewhere, and I'll explain that in a minute. The second document is a cash flow statement. And in corporate accounting, this would start with the net income, and then it would list out all of the expenditures. I would do this differently, and I do this differently if you watch my Friday videos. I start with my beginning bank balance, and I track all the money that comes in and all the money that goes out. And I use this just to make sure that everything that's happening in my bank account is something that I am aware of, that there's no fraud going on, there's no mystery charges, that when something hits my bank account, I can say, okay, I know where this money went and I know what it was for. And so I keep up with that every week. Maybe something that somebody would want to do once a month or even once a quarter, but I usually don't like to let it get too far in the rearview mirror because then I tend to forget maybe what some of the transactions are. The ending balance then in a monthly cash flow statement would be your current cash on hand, right? How much money you have in the bank. The third document is the balance sheet, and this is everything that you own versus everything that you owe. One side has your assets or what you own, the other side has your liabilities or what you owe. In corporate accounting, both sides of this ledger have to balance, and that may not be useful for households because, trying to say, well, I owe so much to this person and that increased this other pot, gets a little finicky. Even in corporate accounting, sometimes it's a little finicky. So instead of doing this, what I would do is a net worth statement. And all a net worth statement is it lists the same things, right? So left side, everything that you owe, or left side, everything that you own, rather, right side, everything that you owe. And you total up both columns and you add them together, and that is your net worth. So because your liabilities or what you owe is a negative number, when you add that to a positive number, it ends up as a subtraction. So let's say you have $10,000 and you owe $5,000. That $5,000 would be minus. So 5,000 from 10,000 leaves you with a net worth of 5,000. So just to recap, income statement, everything that you've earned and all the expenses that you incurred. So essentially how much money you brought in and how much money you either spent or pledged to spend in a given month. The cash flow statement just records all the transactions in your checking account. And then a net worth statement, everything that you own, your assets, and everything that you owe, your liabilities. So getting those three documents together, keeping up with them every month, it may be onerous the first 2 or 3 times you do it, but as you get in the habit, as it becomes second nature, as you adjust, I think you naturally adjust your lifestyle around making these make sense. Then it really does become second nature, and you get a much clearer picture of where you stand every month and where you want to go. So there's one other concept that I want to talk about as it relates to corporate finance, and that is the idea of a fortress balance sheet. The fortress balance sheet is an idea that was popularized by Jamie Dimon, and he is the CEO of JP Morgan Chase, which is the most well-capitalized bank in the United States. And a fortress balance sheet is one that gives you a feeling of resilience, that you can withstand any shock or any siege, right? So it is the concept of a fortress, right? It's thick walls, it's well protected, it's well defended, so that no matter what happens on the exterior, on the battlefield or what have you, you have a way to defend yourself, right? You are protected. If you're in debt, if you owe more than you own, and I can speak to this from experience, you have this constant fear of the boogeyman, of what is lurking around the next corner. Now, this fear for me was not paralyzing per se, but it was something that was constantly on my mind. Like, oh goodness, if something bad happens, how am I gonna pay for it? How am I going to fit it into my budget? How am I going to recover? Whereas when you have a fortress balance sheet, when you are well insulated, and it's not just about having the assets, it's about knowing where those assets are and exactly how much they are. And I'll get into this in more detail later. But when you have that, that fear goes away. You don't have to think about that. You don't have to worry about that so much anymore. You still worry about the big things, of course, at least I do. But the day by day, moment by moment, what if something happens, doesn't really affect me as much anymore. So what banks fear, well, banks fear a few things, but one of the things that they fear is government audits, right? Stress tests, liquidity metrics, things like that. And we saw this in the aftermath of the 2008 financial crisis, where the federal government, the Treasury Department, went in and stress tested all the banks to know how close they were to the edge and how close they were to potentially failing, and how much of a bailout they were going to need from taxpayers in order to unfreeze the credit markets that had all locked up when all the mortgages went bad. So JP Morgan Chase put together this fortress balance sheet so that they could show the Treasury Department, look, you don't have to bail us out. We don't need a government loan. We are okay. And that has helped them to essentially keep the Treasury Department off their back. Treasury's going to go look at others. And because JP Morgan Chase is the biggest, that is important to Jamie Dimon as CEO for the preservation of his company, right? They don't want the government to take it over. They don't want the FDIC walking in, because it's not just about the actual fact of whether they have enough assets or not to cover their liabilities. It's about that perception. So things get into the news, right? The Treasury Department's investigating JP Morgan Chase. They're doing these stress tests. Now depositors are worried. They're going to start pulling their money out. And then the whole domino effect kicks in. And before you know it, a bank that was on perfectly sound financial footing is bust. And so having the Fortress balance sheet protects them from those kinds of perceptions, because they can show it to their clients. They say, look, your money is safe with us. This is how much we have. This is how much we owe. And your money's going to be here when you need it. And so that gives depositors and customers a feeling of security in the bank. Okay. So what makes up a Fortress balance sheet? There are 4 elements. And some of them are, the way that, of course, that it's written is very specific to big banking, right? And being an investment firm and a consumer bank and a commercial bank and all of these other things, but it can be translated into a household budget as well. So the first thing is high liquidity and cash reserves. So this is where you're able to cover your short-term liabilities and easily cover your short-term liabilities. So in household budgeting, we hear this described as getting 1 month ahead, then 2 months, then 3 months, and so on. If you have callable debt or recourse debt, that you're able to service it. So what that means is if you have a car or other vehicle with a note out on it, if you have a mortgage on your home, if you have anything where you have pledged something as collateral, whether it's a vehicle, a house, a motorcycle, a boat, an RV, whatever it is, that you're able to at least make those payments. You're able to service the debt. Not that you can just write a check and pay off the whole debt, but that you are able to at least make the minimum payments or the statutory payments on it. And that doesn't apply to unsecured debt, right? So credit cards, signature loans, anything like that, they can sue you. But if you don't have the cash, then there's not really a whole lot they can do. The worst they can do is force you to go bankrupt, to get rid of the onus to pay them. But they can't take anything from you. So that doesn't apply to that. It only applies to secured debts. Speaking of debt, element number 2, low leverage and low debt. Leverage means debt. It means someone has leverage over you if you owe them money. What you own should be greater than what you owe. And so this, again, goes back to the net worth statement. If your debt is bigger than your assets, paying that debt down should be your top priority, or at least one of your top 2 priorities if you've got some other urgent thing going on with your money. This doesn't mean planning a wedding, buying a house, getting a new car, or something, in my opinion. So if you don't make repaying that debt a priority or paying it down, then you're vulnerable and susceptible, right? You have that kind of fear of the boogeyman. People with huge debt who then want a house, I mean, I understand wanting a house, but at the same time, paying down the debt should be the priority, not getting the house. Because otherwise, what lender will give you a mortgage? And even if you are able to secure a mortgage, you're probably paying PMI, private mortgage insurance. You're paying higher interest, and the whole thing just costs you more. Plus, you're still paying on the debt, right? You're paying high interest on whatever debt you've already got. And a wedding, stretching your financial future or sacrificing it for the sake of a party, I mean, I don't get it. But, I think you can still have a wedding without having a $30,000 party. Okay, enough about that. Element number 3, the ability to absorb losses. So you can better weather market turbulence, and you don't see investments as money you might need. In other words, when you invest in something, you are parking it there for the long term versus, okay, I'm putting money into a stock or a bond or some other kind of investment, but if the poo hits the fan, I can go there and get that money and use that to pay whatever short-term obligation. It's that long-term thinking. And that leads into element number 4, resilience and flexibility. You're able to withstand big economic shocks and take advantage of them by buying what everyone else is selling. There's a famous quote by Warren Buffett. It says, "Be cautious when others are greedy and greedy when others are cautious." So when the market is tanking, meaning everybody is bailing out, that is the time when serious money is made, because it's not just about being able to sell at a high valuation, it's also being able to buy at a low valuation. So those four things go into a fortress balance sheet. And I hope to put together something like that either as an example or maybe even share my own. We'll see. That might be a down the road thing if I ever turn on channel memberships, just because I'm not sure that's something that I want to share broadly. But at the same time, I think it's important not just for my financial future, but for demonstrating or inspiring others to build their own financial futures. And insurance plays a part in this as well. As your assets build, you can raise your deductibles and lower your premiums because those operate in inverse proportion, and then save the difference. So this is called self-insurance, and it means you're able to absorb small costs and pass on big ones to the insurance company, right? So if you have a $1,000 deductible on your car, if you raise it to $2,000, your insurance premiums will go down. And it's worth exploring this with your insurance broker or your insurance company and saying, okay, if I raise my deductible, how much will you lower my premium? And then calculating out how long is it going to take of those lower premiums for you to save up the difference in the deductible. And it's probably shorter than you'd think. Or the difference in the deductible. So with car insurance, some motorists pay big bucks for low deductibles, and then when they have a minor scrape, they don't file a claim anyway because they don't want their premiums to go up. So why did you pay so much money in premiums to have the lower deductible? Just something to think about. So that is it for this week, and this poster is done. My Money Relaunch is going to be taking a small hiatus just because these videos by far take me the longest to record each week. But I will be back in May after the big move, and I'll still have all my other regular videos coming out for the rest of April, and I hope you'll continue to tune into those. For now, have a wonderful rest of your day or evening, and take care.